Hi, and welcome to another edition of Socrates Explains Everything about the stock market. Today we're going to look at the MACD, very useful technical analysis and very commonly used one, which stands for the Moving Average Convergence Divergence indicator. And you can follow along if you're reading my book, Money is Power, How Practice Makes Profits, Mastering the Stock Market. This is in Chapter 9, Computed Technical Indicators, also on page 260. So the MACD is basically taking on, from our previous look at the simple moving average, and here I have in blue the simple moving average for the Apple chart from today. This is a 250 tick chart, and if you haven't seen the earlier videos, every one of these bars is a tick chart. A tick is a trade of 100 shares or more. Each one of these bars represents 250 ticks, 250 trades of 100 shares or more of Apple. The stock is trading around $340, low of around 337 on this here graph, and up to about 343. And the simple moving average, in this case a 20 SMA, is an average of the previous 20 bars closing price. And so it's a trailing average. As the price goes up, the price goes up as well, but it follows it. And you can use this to follow trends, and when you can see when trends break and when you have to consider changing your plans or your strategy. You can see where it follows underneath the trend line and the price bounces off of it again and again as resistance, or when it follows it above the trend line and it bounces off of it as support. Now we're going to be looking at the MACD, which is a very interesting and useful indicator that at first can seem, annoying. It doesn't seem to indicate as much as you'd like it to, and yet there's a lot of hidden information within it. The essence of the MACD is it's two simple moving average lines, but it's definitely more complex than that. This particular one, the shorter of the two lines, is itself the difference between two different EMA lines, or simple moving average lines, SMAs. This is the difference between a 12 SMA and a 26 SMA. It doesn't really matter. Just know that this is the quicker line, and it's again, it really doesn't matter why the line. But this is a slowed down version of that. So this is a 9 SMA of this line. In the end, all you really need to know is that this is a momentum indicator, and the fast line crosses a slow line, and there are ways to look at this graph. One of the most, and the mountain chart down here is in fact the difference between these two lines. As the difference expands, this gets higher, and then it contracts, and it crosses zero. At the same point, these lines cross. So over here, we cross back over here. There's a tiny bump there, a corresponding tiny bump there. We cross here, and again, and again, and again. And these crosses tend to be quite important for your momentum and for trading. I use these. They tend to be a good place to enter a trade, depending on using later strategies. But there are multiple ways you can use the MACD. This is definitely one of them, when the mountain line crosses zero, or these two lines cross. Another one is the fact that this is above the zero line, as opposed to these, which are below the zero line. This is essentially an overbought type condition, and this is essentially an oversold condition, where you expect it not to go much lower or not to go much higher. Now obviously the price can continue to go up before finally giving in. And one of the tricks, one of the most clever aspects, is again another aspect of divergence. Each of these peaks can be considered an important moment, and where they cross tends to be, the peak of it. And you can check on the above chart at what price is that cross, and then you can see here where the cross is lower but the price is higher. the cross is lower, lower and lower, even though the price is higher and higher. This is divergence. The momentum is going weaker even if the price is going higher. I describe this as a crowd in a stadium. This is the noise the crowd is making as the crowd is getting louder and louder and louder as they cheer, but there's fewer and fewer people cheering. Eventually, this is going to break because you can't have less and less people making more and more noise until eventually you get to your downtrend, and then the downtrend kicks in. And again, in a similar way, you can see here, as the price is becoming deeper and deeper, the troughs are not really getting lower. And that again indicates as these become another small aspect of divergence, this is probably the bottom of this particular swing. And you'll notice again and again that the stocks always just swing up and down, up and down, up and down. It's an endless set of pendulums. Some are big swings, some are small swings, some are more of a line, but they end up swinging again and again. And so you're basically always looking at the oscillation of the entire thing. Very frequently you will see a three-wave pattern. You can't see the three waves as much in the stock, although you can in the simple moving average. You definitely can in the MACD as well. Now, one of the nice things about TradeStation is it allows you to program these indicators and manipulate them. There's slightly more to it. I simplified it, but this is essentially the MACD code. Like it's essentially C++ type code. It's your basic kind of code, but this is a thing called easy language that only TradeStation has, and it's one of the nicest things about TradeStation that you can manipulate the charts. If you've done any basic coding, this is very straightforward stuff. You declare your variables. You have three simple variables. My MACD is this fast line. The MACD average is the slower line. The MACD diff is the difference between them, which makes the mountain graph. And those are your three variables. Then you have your three calculations. My MACD uses a function called MACD, which takes two moving averages and then calculates the difference between them. So you have your 12 simple moving average and your 26 moving average, and they're calculated on the close, and it gives you the difference between them automatically. The MACD average takes an exponential average, which is essentially the same thing as a simple moving average with a twist, and it doesn't really matter. It's just a little bit more reactive, and you use an X instead of, if you didn't have the X there, it would just be a normal simple moving average, but this is an exponential average. Again, it's a minor detail, and it's a 9 EMA, or if you prefer SMA, and that creates the slower line based on the previous 9 bars with the averaging the previous 9 outputs. And then the difference is simply subtracting the one from the other one, and that gives you your difference. And your output is 3 or 4 plot lines plotting the 3 variables and one more for the 0 line. Now, the nice thing about this, for me, I like to manipulate my my programs, and what I did is I coded it so that when it makes the crosses, it makes a blob. So it's more visually obvious that it happened. It also makes a sound. That wah sound is the sound of the top. I try to make all my sounds negative when they're going down and positive when they're going up. This particular one is a pot of spaghetti sauce boiling, in my opinion, because bubble, bubble, bubble. And I also coded in to check the price at the point of the cross. And the bigger blob is in divergence because it's a higher MACD and a lower price. And it doesn't happen that often. Here's another one. It shows you divergence. And it lets you know that it's more likely to bounce up. Now, this is the end of the day, and that's sort of the lack of motion happens when the end of the trading day comes around. So the MACD is a very, very useful indicator, there's lots and lots of different ways to use it. The divergence is extremely strong. You won't always see it happen, but if it doesn't happen, then it's probably not as strong a trade. It's probably better to wait till you see a divergent MACD showing the bottom, showing the top. I mean, if you were holding this, and you were at this point, well, you're probably weakening, but that was only 2 bumps. You probably have a third one. But once that third one came across, and you can see it even made smaller weakenings in here, it was giving you a lot of signals that you should probably think about pulling out of this particular trade. So anyway, I knew the MACD was kind of complex because there's lots and lots of ways to use it. Lots of traders use the MACD as well, and there's sort of a hive mind, because if we all decide that this bottom, this third little bounce is going to be the bottom, and we all start to buy it, it's more likely to go up. You can also see we did trend lines in the past. I've pretty much drawn a trend line on every one of the charts up till now, so I'll keep that going. Just happy doing this one here. You can see as you're following that trend line and resistance, as it broke through it, that was your best chance to keep going. It didn't come back and touch it, but it combined with this breakthrough, combined with the MACD bottoming and turning up, and turning them back into a positive. So there were a lot of things to indicate this upwards slope of this angle here is again a positive indication that we're moving. And this is momentum. Momentum does not tend to reverse. Now this was reversing momentum. So it gets a little bit choppy on there. But once it's cleaned itself out, and you can see this is actually increasing. Up to this point, the momentum was increasing up to right here. And it carried its way, till about there. And you'll notice it pretty much always lines up with the price. Well, they'll line together. There's a reason these things follow each other. I mean, everything is calculated off the price. All these calculations are coming off these closing prices. So by definition, what this does is going to influence this. Anyway, that's the MACD. This stuff is cool. Unlike a video game, you can make literally billions of dollars playing this particular game. So I'll see you tomorrow. We'll do some trading and let's make some money.